Hello class, this is Dr. Fenton. In this video, we'll cover Chapter 13 that talks about capital budgeting decisions. So again, read this chapter in detail so you'll have the background information as I go through the various examples in the chapter. Now, what is capital budgeting? As you can see here, capital budgeting is the process of planning significant investments in projects that have long-term implications, such as the purchase of new equipment or the introduction of a new product. So we're talking about major decisions here. These could be multi-tens of millions of dollars or hundreds of millions of dollars decisions. Are we upgrading the factory that we have, the manufacturing plant? Are we building a new office building? Are we buying equipment within the factory? So we need to make sure on these large investments, are they going to give us the payback that we want? Are they going to give us the return, that return on investment that we are looking for? They show you typical capital budgeting decisions, 1 through 5 down here. So the first couple, cost reduction decisions. Should you buy new equipment to be purchased to reduce cost? Should a new plant, number 2 here, should a new plant, warehouse, or other facility be acquired to increase capacity and sales? And then you can look at 3, 4, and 5, various decisions. So again, these are major decisions, and you want to make sure that the return you're going to get from these investments meet what you would like to have, the kind of return on investment you would like to have. Now, cash flows versus net operating income. In this chapter, we are going to concentrate on cash flows for the most part. So if we are given like an income statement, and we have like an operating income or net income figure, we have to convert that back into a cash flow number. So we're going to be looking for cash outflows, which will be things such as more cost involved, cash costs going out the door. We're looking for the cost of the building or the equipment that we're thinking about purchasing. And then cash inflows will be actual increased revenues coming in the door, or it could be reduced cost. So we're going to treat both of those the same, whether it's additional cash revenue coming in the door or cost savings where we don't have to pay cash out the door. Both of those will be treated as cash inflows. Now, a very important concept in this chapter is the time value of money. I prepared another short video talking about the present value tables in Appendix 13B, so make sure you look at that. First way to evaluate a project, this is a very simple way to do this, is called the payback period. The definition here is the length of time that it takes for a project to fully recover its initial cost out of the net cash inflows that it generates. So let's say you buy a machine that's more efficient, so it saves cost, it saves cash going out the door. So that cash inflow, which again, it can be a cost reduction, is a cash inflow. How long will that extra net cash inflow take to pay for the machine on our cost when we bought it? Very simple formula. Payback period is equal to the investment required, again the cash investment, divided by the annual net cash inflow. And the answer will be given a number of years. So the example they have down here, 2 machines. If the first machine, machine A, costs $15,000, and we get net cash inflow every year of $5,000, you can see quite easily it takes only 3 years to recover that initial investment. Machine B costs $12,000, net cash inflow $5,000 per year, then it only takes 2.4 years to recover this investment. So this method here, the payback method, does not have anything to do with the present value computations. We'll get that in the the net present value method. But this is a simple method. It is used quite a bit in business, especially businesses that want a very quick return on their money, a very quick payback period. Let's extend that example somewhat. So let's say that we have, looks like an amusement park, and here are the current set of numbers. We have sales down to contribution margin, some fixed salaries, maintenance, depreciation. So the net operating income is $20,000. We just talked about, though, on the previous page that we need to convert this to a cash flow number. So the $20,000, looking at this schedule here, will need to be converted into this cash flow number by adding back any non-cash expenses that are in that income statement. So depreciation, as you know, is a non-cash expense. So we take the $20,000 in net operating income and add back this non-cash deduction for depreciation. So now we have our net cash inflow of $30,000. Also, the machine will cost $80,000. I think that was up here, yes, $80,000. But what we can do, we can sell the old machine for $5,000. That's going to be a cash inflow. At the same time, that first year, you buy the new machine, sell the old one. So the cost of the new equipment is $80,000. Salvage value that we can get from the old equipment, $5,000. So our investment this first year is only $75,000. So now we've converted net operating income into a cash flow number, and we found our actual net investment, net cash going out the door today to buy the new equipment. Plug the numbers in, 75 divided by the 30, so it takes us 2.5 years to recover this investment. So the payback period is 2.5 years. Using the payback period to analyze an investment is not quite easy if the cash flow is not steady. So we have another example. Let me move the screen down a little bit more, right there. And you can see that the cash inflow is not the same each year. And in fact, we have two investments we have to make for this asset, $4,000 in the first year and another $2,000 in the fourth year. So how do we find the payback period when we have like two different cash investments in two different time periods and this uneven cash flow? Well, it's not too hard, but again, not quite as simple as the first one where there's just like one division to work through. So let's start here. At the first of the year, you pay $4,000 for the investment. In that first year, the cash inflow from that investment is $1,000. So the unrecovered investment is $3,000 at the end of the first year. $4,000 minus 1, $3,000. In the second year, there's no cash inflow. We're still at $3,000 unrecovered investment. In year 3, we have $2,000 cash flow from this investment. It drops our unrecovered investment down to $1,000. So the $3,000 minus the 2 gives us $1,000. So we almost have it recovered, but in the fourth year, we have to pay out another $2,000. So we go from $1,000 unrecovered investment, add $2,000 more, so we're up to $3,000 unrecovered investment when we make the $2,000 payment at the beginning of year 4. Take away the cash flow in year 4 of $1,000, and we're down to $2,000 unrecovered investment. So again, the computations one more time. We were at $1,000 end of year 3, unrecovered investment. We had to make another investment, $2,000. We're up to $3,000. Subtract the $1,000 cash inflow. We're down to $2,000 unrecovered investment end of year 4. Year 5, we have $500 more cash inflow. So take that from the $2,000. So at the end of year 5, we have the unrecovered investment of $1,500. Then look at year 6. We have $3,000 of cash inflow coming in the door. We only have $1,500 starting into year 6 of unrecovered. So you can see that sometime in year 6, we get it fully recovered. In fact, if we have $1,500 in unrecovered investment starting year 6, and we generate $3,000 in year 6 of cash flow, it takes only a half year to get that recovered. So that's why they show us down here. It's up here. That takes 5.5 years to recover the investment. And that's how we did it, manually, one at a time. We got through year 5, still haven't recovered everything. So 5 full years so far, and then part of year 6, not a full year. So that's why we're at 5.5 years as the payback period. In this situation, when we have two different timing of investments having to pay out and these uneven cash flow numbers, it can be done a little bit awkward, just year by year. You have to go through and count the years to see how it's being paid back. The net present value method is probably a more accurate method that can be used to evaluate whether to make an investment in these long-term assets. Let's see what this talks about. We have example C, and it says that Harper Company is contemplating buying a new machine. It will cost $50,000 and it will last for 5 years. The new machine should reduce labor cost by $18,000 per year. So as we talked about earlier, saving cost is treated as a cash inflow. So this is going to be a cash inflow number, $18,000 per year, because we don't have to pay that out the door. We're saving that, so we treat that as cash inflow. At the end of the 5-year period, we can sell the machine, we think, for $5,000. That's our plan. And the company has an 18% return on all investment projects. So what we're going to do is evaluate this and come up with an answer that's called net present value. So what is the net present value of this investment? Now, the initial investment means today we're paying $50,000 for the machine. So this is a cash outflow, negative numbers, cash outflow today, now. Annual cost savings. The machine will last 5 years. So for each year, 1 through 5, we are going to save $18,000, and we treat that as cash inflow. So this is years 1 through 5. Each year, we're going to have cash inflow of $18,000. This is not a one lump sum $18,000 amount in the future. This is $18,000 per year for 5 years, cash inflow. Salvage value of the new machine, we expect to sell it at the end of the 5th year for $5,000. So this is a one lump sum $5,000 amount out in the future, 5 years from now. So bring the numbers down, and we have total cash flows for each of these categories. Now, $50,000 is going out the door. Now, ask the question, what is $50,000 today worth today? Well, it's worth $50,000. That's why this discount factor is 1.0. It's a dollar today is worth a dollar today. So this $50,000 figure going out the door today, what is the present value of that cash flow? What's the present value of $50,000 going out the door today? $50,000. Now it's different for the others. We have different discount factors. Now, if you saw the video for the present value tables, you'll know that we have to look this discount factor up by knowing two things: the number of periods and the discount rate. They have a minimum required rate of return of 18%. So let me show you the table, and I'll show you where the 3.127 comes from. Remember, 5 years, 18%. So here we go. I have it in red here. Along the 5-year row, under the 18% column, there's the 3.127. So this is what they call the discount factor that we use to find out how much are all those $18,000 payments each year for 5 years worth today. We will take $18,000 times the 3.127. Now notice we use table number 2 here, the present value of an annuity of $1. And this means we have the same dollar amount every year for so many years. So that's why we use the annuity of $1 table. So again, 5 periods, 18%, 3.127, and there it is. So when we take $18,000 each year for 5 years, but $18,000 times the discount factor of 3.127, we get $56,280. So those $18,000 payments each year for 5 years, bring all those payments back and give me one number today that all those are worth in today's dollars. Again, at the 18% discount factor, that'll be $56,286. So once again, those 5 future $18,000 payments are worth $56,286 today in today's money. The next column, this $5,000 amount, cash inflow, that we're going to receive when we sell this machine at the end of 5 years. This is our expectation. You find out what is it worth today. This $5,000 is a one lump sum amount in the future. We wait to the end of 5 years, then we sell it. So $5,000 coming in the door. We have a discount factor of 0.437. So where does this come from? Up here. Again, 5 periods, 18%, present value of $1, because this is a one-time receipt in the future. $5,000 we're going to get from selling the machine after we use it for 5 years. That's why we use this table, the present value of $1 table, because that's a dollar amount in the future, one time in the future. What is that worth today? Multiply, and it's worth $2,185 in today's money if you're working with the 18% amount. What we're going to do then is net these together. We have cash outflow, present value, and then we have present value of cash inflows, the annuity and the lump sum. So take these cash inflows, subtract the cash outflow, and the net present value is $8,471. We have a positive net present value here for this answer, which means this investment is earning more than 18%. If this investment was earning 18%, and that was our required minimum return, 18%, and it actually earns 18%, the net present value would be 0. But we want to have an investment worth at least 18%. This one's earning more than that. So the net present value is positive. It's $8,471. And this is showing us that we can get the same number if you want to take 1 year at a time and work through the numbers. There's no reason to, but you could if you wanted to. And so, at the end of 1 year at 18%, then you have a factor of 0.847. So let's see where these numbers come from. This looks familiar to you. It should be 5 periods, 18%. This would be 4 periods and so forth. So remember these numbers. Let's look at the chart for a second. And here they are, the 0.847 and all the others. If you do it 1 year at a time. But there's no need to, because we have the same dollar amount every year, and we could use the other table like we did down here earlier. But that's showing you that you could use each year separately if you wanted to. You get the same result. Let's go down here. Again, this is what I mentioned a second ago. If the net present value is positive, then this project is acceptable because its return is greater than the required rate of return. At 0, it's still acceptable because it is earning exactly the required rate of return. But if you end up with a negative net present value, the project is not acceptable because its return is less than the required rate of return. This is just a quick example you can look at when you have time. This is just showing you that, looking at the cash flow numbers, negative, positive, and this is the 1,000 amount coming in each year for 4 years. If the net present value is 0, then this is earning 10%. The required rate of return is 10%. It earns 10%, so therefore the net present value is 0. Let's look at a little bit larger example here. Bring this up a little bit more right here. In this example, we have the cost of the equipment of $60,000. But we still have to tie cash up in working capital if we purchase this equipment. This can be increased inventory amount, maybe increased receivables. Some of the current assets are going up, usually inventory in most cases. So this is going out the door at the beginning, but then it's recovered at the end of the 4-year period or 5-year period for this equipment. The equipment has to be overhauled in 4 years, spend $5,000. Salvage value we expect to get for the machine when we sell it at the end of 5 years is $10,000. And here are the expected sales revenues and cost of goods sold and out-of-pocket operating cost. So this has already been adjusted for non-cash items. So this is a cash flow cost right here, annual cash flow cost. So what do the numbers look like in the table? Here we go. Today, they call it now, but today the equipment costs $60,000, negative cash outflow. We also have to put in $100,000 in additional working capital. Again, probably increased inventory. So that's a negative cash flow going out the door today. That totals today $160,000. The discount rate, 1, because this is money going out the door today. What is that money worth today? The same amount. Now for year 1, we're preparing sort of like a little operating statement, income statement kind of thing. We have the revenue coming in, cash revenue coming in, cash cost of goods sold going out the door, and then cash out-of-pocket expenses. So it nets out $40,000. Same for years 2 and 3. 4 is different because we have to overhaul the machine in year 4, so we have an additional $5,000 going out the door in year 4. So that means the cash flow in year 4 is not the same as in years 1, 2, and 3. And then get into year 5. Again, we have the revenue, out-of-pocket expenses. We can sell the machine for $10,000, we hope. So that's cash inflow coming in. And also into year 5, that releases the working capital. We don't have to have as much cash tied up in inventory. So we get that money back. That's cash inflow. So you can see the net cash inflow is $150,000. We're talking about a 5-year period. We're looking at 14%. So we are going to take this year by year because we don't have even cash flows every year. We could combine these 3 years, but we're not going to in this example. Okay. So we need to find these factors from the table. Since we are looking the factors up year by year, I want to find the present value of this $40,000 and then of this one and this one, and then the present value of the last two, the $35 and the $150. We go to table number 1, the present value of $1, because we're looking for the present value factors for one lump sum amounts each year separately. So 5 periods, 14%. So we'll see these factors in the table. Here's 14%. So here they are, right along through here, from 0.877 down to 0.519. Present value of $1 table, number of periods, and the discount rate. So remember these numbers here. And there they are, coming up across here. Multiply, find the present value of each of those. And now what we do is take this positive cash inflow, net present value of this positive cash inflow, subtract the current cash outflow at its present value, and we have a positive net present value of $31,410. This is more involved because we have investment in working capital that we have to use cash today, but we receive back in the future. We have a lump sum cash payment for overhaul in year 4, and then we're taking it year by year. So that's a quick review of the net present value method. The internal rate of return is another method that we can use to evaluate an investment decision. Now in the previous one, the net present value method, we did not compute what the actual return was for that investment. Now we did know that it was either above or below or equal to the required rate of return, but we did not know exactly what the return was. In this method, we find the return, and we find it as a percent. So we have an example here. The school district wants to purchase a large tractor pull lawnmower. The mower will cost $16,950, useful life of 10 years. At the end of 10 years, no scrap value, so there's no salvage value to sell it for. But it will save $3,000 each year in labor cost. So here's the cash inflow each year for 10 years. Here is the cash outflow in the current year. Well, let's make a computation and find out the exact return it's generating for us. let's use this ratio. So the factor of the internal rate of return is equal to the investment required, $16,950, divided by the accrual net cash inflow. And here are the numbers plugged in here. 16,950 divided by 3,000, so 5.650. That's the discount factor. We don't know the percent yet. What we do is take this discount factor, go to the present value tables, and find out what percent this relates to. We have to remember, though, that this has a 10-year useful life. So let's go to the present value of an annuity table, since we're dealing with $3,000 per year each year. So the annuity table, 10 periods, and look for the factor of 5.65. Table, 10 years, and you start going across. Where's 5.65? Here it is. Let's go up 12%. So we had the factor we computed a minute ago with that computation. Had to remember a 10-year period we're dealing with, find the factor, and go up and find the percent. So this project, given its numbers, is generating a rate of 12%. And that's what they say in here. Project will be 12%. If you wanted to go through the net present value method, you can do that. And you'll find out that it has a net present value of 0. Net present value of 0. Okay, so then they discuss comparing the two methods. You can read that on your own. Here we expand the net present value method a little bit more. So what we see here is we have two alternatives we are comparing. Do we keep the old ferry or buy a new ferry? And so this shows us that if we keep the old ferry, we have to renovate now, $200,000 going out the door today. We can see the revenues each year, 1 through 5. The cash operating cost each year. In year 3, we have an $80,000 repair if we keep the old ferry. And at the end of year 5, we can sell the old ferry for $60,000. So what you want to do then is bring the net cash outflows here and inflows for each year into these numbers. Find the present value calculations. Looks like they're working at 14% for each of these periods. Here's the present value for each cash inflow. So net these together, or add these together, subtract the $200,000. So the net present value of keeping the old ferry is $120,340. If we buy the new ferry, it'll cost $360. We can sell the old one, positive $70 coming in the door right now. Revenues are the same. Costs are lower though compared to the old ferry. So we save money here. We pay out $30,000 instead of $80 to repair the new ferry in year 3, and we can sell it in year 5 of 6. So net all these numbers down to get the cash flow for each year. These are positive cash flow numbers. Add these together. Subtract 290, or make the cash flow here first. Now, after we get the net cash flows for every year, these are positive, this one's negative, we compute the present value for each of those, and then what we'll do is take the value of all these present value amounts, add them together, subtract 290, and get $372,970, the net present value. What we do in this case then is compare this number for the new ferry to the old one, and we can see that we would be $252,630 better off, in favor of buying the new ferry. So you can see net present value allows you to compare two or more alternatives at the same time. These are more examples you can work through. Again, everything should be about the same. Let's look at the next page. Yes, don't worry about this page. Let's go to the next one. Now, when thinking about ranking the investment projects, this would be when we have, as is the typical case, a limited amount of funds to invest in projects. So which one should we choose? If we're using the internal rate of return method, of course we should choose the project with the higher internal rate of return. That's easy to do. If we're using the net present value method, though, it's not easy unless the investment amount for each project is exactly the same. In this example, they're showing us at the bottom, the investment's not the same, the initial investment. So what we're going to do is take the net present value of each, $1,000, but you can see investment A has a $10,000 investment requirement and B $5,000. Let's divide the net present value of the project, you take each one separately, by its investment required. So there's the formula being shown. And so then what we come up with was something called the Project Profitability Index. So we can see that if we take $1,000 for investment A, the net present value, divide by A's investment required of $10,000, the profitability index is 0.1. B is going to be different because even though it has the same net present value, it only requires a $5,000 investment. So divide $1,000 by $5,000 and the profitability index is 0.2. So in this case you would choose B because it has the highest profitability index. The last technique in this chapter that's used to evaluate business investments would be the simple rate of return. Now in this one, we're going to get away a little bit from the cash flow method specifically because you'll see in a minute that we do account for depreciation expense. To compute the simple rate of return, you can see the formula. We divide the annual incremental net operating income by the initial investment. Let's look at some numbers. Here we have a machine that if we buy it, it would increase revenues by $90,000 per year. The operating expenses would increase by 40. This would be the cash expenses. And we have to compute depreciation. Cost 180, 9-year useful life, no salvage value. So here's what the incremental net operating income would look like. Revenues would go up by 90. The cash expenses would go up by 40. The depreciation expense would go up by 20. So $60,000 in expenses, 90 in revenue. So the annual incremental net operating income, if we buy this machine, will be $30,000. What is a simple rate of return? Take the $30,000, divide by the initial investment, 180. You can see it down here. And so 16.7% is what's called the simple rate of return. Now you don't have to have revenues coming in the door to compute this. So this next example shows cost savings. So they currently sort eggs by hand, cost $30,000. They're thinking about buying an egg sorting machine that costs $90,000, 15-year life, no salvage value. It would cost $10,000 per year to operate and maintain. The current used egg sorting equipment could be sold for $2,500 today if we buy the new machine. So even with no revenues, we have an increase in your net operating income because we have cost savings. The new machine would save $30,000 in cost. It would increase expenses $10,000 to maintain it, and then depreciation $6,000, so $16,000 in increased cost for the new machine, but we would save $30,000 because we're currently hand sorting the eggs. So our net operating income would increase by $14,000. The new machine costs $90,000, but we can sell some old equipment for $2,500. So our net initial investment today would be only $87,500. Let's take the two numbers and divide. So $14,000 divided by the $87,500. So 16% simple rate of return in this example. This page on post-audit of investment projects is just saying that after you invest in a project, then as you start using it in year 1, 2, and 3, then go ahead and analyze what's going on. Is it hitting the marks that you thought? Is it generating a net positive cash flow? Is net present value still positive? and you're looking at actual numbers now instead of estimated numbers. So it's a way to evaluate your decision, and maybe this will give you, hopefully it will give you better information in the future so you can make even more accurate decisions as you go forward. So this chapter has shown us several tools we can use to evaluate major investments in equipment and buildings and so forth. You start out with a payback period. We had net present value, a simple rate of return, accounting rate of return. So companies can use a variety of these, or just one if they feel comfortable with one. So there's a lot in this chapter. Again, it also picks up the present value concept. So again, read the chapter in a lot of detail, and good luck with your studies.